Welcome to the Uncontested Investing Show, presented by REI Inc. magazine and sponsored by RCN Capital. Each week, we focus on bringing you candid convos from the best in the biz. Here's your host, Tim Herriage.
Oh, welcome back to Uncontested Investing. I'm Tim Herriage, your host. Thanks for coming back. Today, I have an industry legend, Josh DeShong. Josh, thanks for being here.
Thanks for having me, Tim.
So Josh, if you want, just take a couple minutes and just say a little bit about yourself.
Yeah, so I'm Josh DeShong. I started in the real estate space 15 years ago as at the ripe age of 17. I got licensed immediately after turning 18. Joined Keller Williams Realty, became one of the top 10 agents in the country. Underneath them, I was a Wall Street Journal ranked real estate agent. Back in 2012, I decided to invest in real estate, but mind you, I had gotten just gone through the worst housing recession in history, right? So, and I didn't know anything. So I started investing in 2012, did well. 13, I bought, actually in 12, I bought 2 houses. 13, I bought over 30, and then 14, I bought over 100. So the story kind of goes from there. Started buying, fixing, flipping, holding for rent, and then I actually started wholesaling. So I came at the wholesale business the opposite direction. I think most people start with wholesaling, and then they get into fix and flip. I went the opposite. So I went fix and flip into wholesaling. To now, we built a platform for wholesalers and investors to give them a safe space to transact. So high level, that's me.
So you're a bored person that never does anything.
No, I bite off more than I can chew most days. So.
I think most of us do. So I like to start each week with what I call the bottom line up front. The bottom line up front, the bluff. When I was in the Marine Corps, we had briefed the general, and we were always taught never bury the lead, because the general may have to get up and it may be combat, or there may be mortars coming in, and you've got to make sure that the general knows the most important thing. So I start each week with 2 minutes. It's just you and the guest. Talk about things they should be looking at this time in the market, things you think they should be doing, if there's anything you think they shouldn't be doing. It's just 2 minutes, you and the audience.
Yeah.
Going now.
All right. So I love that you do this. I think this is really important. And I think there's, the times we're in, this is a perfect piece of the segment, right? So I've been thinking all week about what I would share and what I think is important and everybody should know and be paying attention to. And I was reminded by a conversation I had 2 weeks ago. I was talking to an investor, and he said, I only care that I make $20,000 per deal. I thought that was an interesting statement. Now, this particular investor buys 20, 30, 40 houses a year. It's actually a very experienced investor. But I was reminded that in times of expansion and opulence and everybody doing well, we tend to lose sight of what matters. We tend to forget the basics. And with that statement, what matters? So I challenged that person. I said, would you be willing to make $20,000 on a $100,000 deal? The answer was yes. Would you be willing to make $20,000 on a $3 million deal? The answer was no. So clearly it is not, I need to make a $20,000 minimum. So right now we have increased risk. You should size the returns you expected against the risk you're willing to take, and understand every property you buy you're taking risk. Whether you're buying in a high-end area, a low-end area, it doesn't matter. Everything has risk associated with it, and make sure your return expectations are properly aligned.
So that's good stuff. So risk versus reward, right?
Right.
It's kind of like telling your kid, I'll tell you a funny story. So I was in Vail this weekend, and my wife texts my 12-year-old and says, what are you eating for breakfast? He says, I'm making cinnamon rolls. And I'm like, what? And she says, she says, how do you know, who's helping you with that? He writes back, I read the constructions. He still calls instructions constructions because his entire life, like he wanted to know how to build something. I'd say, let's get the instruction. In his mind, he was saying construction. So
yeah.
Instructions are still construction. Anyway, I grabbed the phone and I called and I'm like, stop, right? Like, he's like, but Dad, I'm hungry. I'm like, your grandmother's there, right? Yeah, well, get her to do it, right? So, but to him, he just wanted the reward. He wasn't worried about the risk.
Right.
And I think in the last, call it really 10 years, but we'll just say 4 or 5 years for sure here in the DFW market, and really every market, we haven't really had to worry a lot about risk, have we?
Nope. That's something that's just been thrown to the wayside. We're talking to many investors. I think it's a national thing, honestly.
So what type of risks are we looking at these days?
Yeah. So if you look at economic makeups of communities, different classes are going to be affected differently over the next 5 to 10 years. And property values could come up, could come down. Rents are going to go up, rents are going to go down. And that's going to happen differently based on the price point that a home is in, right? And so I think the biggest risk that investors face is not properly understanding an area and what they should be making relative to the risk, the inherent risk that area possesses. For instance, a rent-heavy market. There's one market here, Louisville. A rent-heavy market could absolutely affect home prices. You have a high degree of tenants, quite a few tenants. So what is controlling housing prices in that market might be more tied to the property values than, say, somewhere like Plano, where a lot of people just want to move in and live, right? So you understand, if yields get compressed with rates increasing, you're going to see a lot of people pulling out of Louisville. You're going to see a lot of investors pulling out, which could cause some price instability.
So one of the biggest themes that I've found with the guests on this show is, number one, I'm not as smart as I thought I was. And number two, they monitor data in little unique points of information that I hadn't even thought of. So that was one of them. We're going to talk about that later, kind of the market makeup, the saturation, if you will. What are some other things that maybe potential risk or things that you see happening in the market today?
Yeah, I think there's a lot of people that have used debt improperly, and you've got a lot of people who haven't used debt properly at all, right? And so the people that use debt improperly, they're going to face some compression. Their yields are going to get tight, and it depends on what they're going to do next. Are they going to deed in lieu? Are they going to sell off to an institution? Or what's going to happen? That'll be really interesting to see. There's also been this other weird component where people have actually done cash out refinances and bought cryptocurrency, right? And so there's a lot of investors who've actually done that. What's going to happen? I don't know. I don't think anyone does. But those are risks, and those are outlying risks that we need to be aware of, because it could cause a domino effect.
Yeah, I think when we look at the J.P. Morgan and like Wells Fargo and Citibank reports, and we see all of this money people have in their savings accounts, and you look at the trillions and trillions and trillions that has been generated recently, and then the rise and fall of Coinbase and Robinhood and some of these altcoins. I won't go into the basic fundamentals of cryptocurrency, because that's
absolutely,
definitely get some haters there.
Always.
But risk. Right?
Yeah.
This coin is not backed on anything. Let's buy 5 million of them and hope it goes up 1/1000th of a cent, and I can make some money. And then I'm talking about Shiba.
Yeah.
Like as of yesterday, it was down 90-something% this year. Right. So if you did take a cash out refi and you stuck it in there January 1st and you held the line is almost evaporated.
Yep.
So. But that brings on another value store, inflation. How are you adjusting your real estate business or businesses to deal with rising rates and rising inflation?
Yeah, so since 2020 started, my plan has been effectively the same, and I haven't really changed it. I'm trying to stay pretty even from a cash to debt to trapped equity to assets. I'm trying to stay even across, so that way if the markets continue to grow or we continue to see inflation, I have real estate assets, and inflation is a natural debt reduction strategy, right? Because Value goes up, the debt doesn't change. So, but I'm also hedged in a way that if the markets go down, I'm in a good buying position. So I haven't been all, real estate or all equities. I've been cash, real estate, commodities. I'm pretty even in debt. Debt, I'm thinking of almost like gold. So,
well, last year, my wife and I did dozens of loans with RCN Capital. And some of our rates were below 3.5%. And some of them we even paid prepayment penalties on the previous debt just to go ahead and do it. Average portfolio, I think our portfolio is levered at like 67%, 60, right at 70, right under. And I told my wife that debt is now almost an additional intrinsic asset. Right. That is attached to the property. And it's funny to hear you call it trapped equity. In the last week, I've seen a lot of people talk about this. I've seen them say dead equity, trapped equity, unrealized equity. And I don't know. I mean, it's an interesting line of thought. I like the ideology of, and I've never heard it positioned that way, Josh, that it's a tool to harness inflation. And that is very interesting. I know I'm getting geeky on you here.
Yeah, no, I love it.
I like to think and learn to think the way other people think. And one of those people that talked about debt equity was talking about they were going to get rid of their debt equity and get into multifamily. I know that you and I have both, I see the smile, you and I have both studied a lot of history.
Yeah.
And we look at units coming online and available housing inventory and cost per square foot and some of these things that you can really quickly find things that are out of line. What are your thoughts on multifamily right now?
So if, the definition of a bubble is something not everyone can see or most people can't see, right? So I think that if there is a bubble in the housing market, it is more in the multifamily side than probably anywhere else.
That's the debt that I'm worried about. And I want to talk about that here in a little bit, but right now we're going to take a break. So stick around. We'll be right back.
Are you looking for fast funding for your next fix and flip? What about leverage for your next long-term rental or vacation rental? Need capital for a new construction project? Look no further. RCN Capital has you covered. As the leading nationwide lender for real estate investors, RCN Capital offers short-term and long-term financing solutions for your next investment property. RCN Capital takes a common-sense approach to your loan request, offering high leverages and low rates backed by superior customer service. Whether you're investing in single-family properties or multifamily properties across the U.S., RCN Capital has funding options for you with no hoops to jump through and quick closings in as little as 2 weeks. Ready to get a quote for your next investment property? Visit rcncapital.com/podcast to apply today. There is no fee to apply. Again, that's rcncapital.com/podcast to apply today.
Welcome back to Uncontested Investing. I'm Tim Herriage, your host. I'm here with Josh DeShong. Josh, I want to stay on multifamily because I really like people to send me hate mail.
Get it.
I've seen a lot of balloons. I've seen a lot of adjustable rate mortgages. I've seen a lot of 2 and 4% cap rates. And I am comparing a lot of what's happening in the housing market right now to the early 80s. And in the early 80s, inflation was at all-time highs before this month. Inflation and interest rates were at all-time highs, more than 2x what we're at right now. And yet single-family values continued to go up.
Right.
Housing units sold per capita was at a nearly all-time low. We're now below that. But multifamily construction and deliveries was just chugging along. And then in the late 80s, the bust of the savings and loan and of the DFW area was not single family.
Right.
It was multifamily. And if you drive along Garland, Texas, there's still, to this day, 40 years later, some concrete pads along the highway that just never got built. We won't talk about the guy's name, Faulkner. So anyway, long introduction. What were your thoughts on multifamily?
Yeah, so I agree with you in many respects. So I could probably make that picture even scarier. If you think about what happened in the housing crash, so it wasn't just that people got loans they shouldn't get. It was also that those people were bundled into mortgage-backed securities that were improperly rated. And so there wasn't alignment in understanding of what type of borrower should go into which bucket. And it's the same thing we talked about earlier in the segment, right? Risk to reward. So what happened is you take somebody who is truly a double B borrower, you put them in a AAA bond, and you're selling that AAA bond at a AAA return. But you're not factoring in that new risk on that that double B buyer, right? So one of the big problems that led to the housing crash was just misallocation of how we were bucketing risk. And banks then took bets on that risk and how it would perform, and private equity took bets on that risk, and everybody was betting on something that they didn't actually understand the makeup of, right? So back in what would you say, Tim? Was it 2014 when all the syndication started going nuts?
It was 14, 15, and 16. Really, everybody was a syndicator at that point.
Yeah, and so what they were doing is they realized, hey, there's upside on yield. So let's go find a C-class property. Let's slap some lipstick on it. Let's call it a B-class property now. Let's get a bunch of C-class tenants that were willing to pay B-class rents, so we can now sell this property as a B-class property. Right. But it's not. It's not. So to the mortgage piece, if a certain percentage, just like with the mortgage-backed securities, if a certain percentage of those tenants fail, or those certain percentage of those borrowers fail, the whole thing comes crashing down. Well, right now, interest rates are going up, meaning access to capital for these owners is not going to be something that's easy to acquire. So if their tenants start falling out, we're going to have some problems, and I see that as a really big issue. And it's hard to get all the data centrally located, but there's definitely something there that we all should pay attention to.
I remember in 2006 and 2007 when I was flying around on American, and back then in first class they had a magazine. Now we don't do magazines anymore, but I remember right before the crash how every page had a different condo high-rise that was not built yet. But if you're willing to wire on $500,000, you can go ahead and get yourself a spot. And there's a lot of that.
It's happening again.
I was in Miami last month, and there are a lot of cranes. But I don't want to belabor this point, but you did say crashing, and we're going to talk about that later. What are some things that have been kind of some challenges for you in this business or this industry?
Oh, sizing risk. Since we're talking about that, I would say that's a big one. I would say not getting longer term debt. There was this, when I got into real estate, everybody was preaching 15 years and not 30s. Right. And now, knowing what I know, 30s are better, and you pay down with your additional cash flow, right? But 30s allow you to be more flexible. Right. So for your 10, you got to get your Fannie Mae 10 allotted, right? So, and then after that, build really strong relationships with banks. I'd say that would be number one. Yeah, biggest mess up I've made, Tim, is not keeping a lot of the houses we bought and sold over the years.
It has been a difficult 2 years of driving around neighborhoods, and it's like, oh, look, honey, it sold for $250. We used to buy that for $40. And I bought a lot on Canada over by Trinity Groves one time for $3,000. Yep. The lot's worth $200 now. Yep. Just the lot. Yep. If I'd built a house on it, it'd be worth $500. So there's a lot of that, right? A lot. And my biggest piece of advice to investors lately has been one more. And they'll say, one more what? Just keep one more. Yep. Whatever it is. Like if you plan to do 11, do 12. If you plan to do 20, do 21. After 22 years in the business, it would be well over $5 million in net worth.
Oh, easily.
Right now. We're not talking about asset value. Yeah. It would be over $10 million in asset value. Yeah. It'd be $5 million in net worth. Yeah. So, and just a small correction on the 30-year loans. Once you've got your Fannie Mae 10, you can come talk to RCA.
Oh yeah, there you go. We go talk to RCA.
30-year fixed rate.
Huge advantage, which might I say.
Yeah.
Huge advantage. That wasn't a thing, 10 years ago, that wasn't a thing. You couldn't get long-term debt on
Before the
rental
crash,
property.
we were paying 9.25% at the bank, and it was a 2-1 adjustable.
Yep.
And we were happy. That was a good rate.
They still had massive equity requirements. They
Right.
still had all those things, right? Like, that's insane. We've come so far.
And that's another thing. I hate to get off topic, but that's another thing that's going to hurt investors. The people that didn't listen to me screaming from the rooftops the last 5 years to leave the banks. Because I remember April 2008, like no tomorrow, when First Bank of Canyon Creek in Richardson, Texas called my line due.
Yeah.
And there was a dark time for me and my wife. And thank God we had enough relationships and a big enough network where we were able to get that line cleared off. But, and I found out the reason my line got called is they knew I could pay. The people that didn't think could pay anymore, they got workouts. Their lines didn't get called.
Oh, wow.
Yeah, they got reduced interest. They got, they got the sweet deal. And so if someone's out there listening, they just need to understand that you may be thinking, well, I'm bulletproof. Well, guess what?
You're not.
If you're bulletproof, you're the one they're going to ask for $1 million because they're like, oh, well, he's got it, right? And we want that, right?
Yep.
On that topic, because that was my worst thing I ever went through.
That's a nightmare. Yeah.
Talk about like your biggest loss or your biggest challenge, negative thing in the business.
Oh my gosh. So, this is one of those things we talked about the other day, and I was like, man, there's like a dozen, there's 2 dozen answers here. One, I can tell you we made a $500,000 mistake once because we tried to get too smart. We thought we knew what we were doing. We started using advanced email systems and whatnot and lead routing, and a lot of our leads were going into La La Land. And so we backed in. Now this was in the brokerage space, so we were able to actually quantify what our loss was over a 12-month time frame, and it was $500,000. Oh. And so that was, thinking you know what you're doing, always check to make sure you still do, right? Like I'd say that was a big one. Gosh, there's just been so many.
Well, let's be positive. What about a big win? Something that went your way that.
So I got one actually that's really good, and I think it's a win and a loss, and it's a loss that we turned into a win. So about 7 years ago, when we were running our brokerage team, JT, who's head of sales at our organization, JT was managing some of our agents, and they're making sure they were hitting their leads and calling everybody they were supposed to. And we get a lead that almost looks like spam. It comes in and we can't really tell what they're asking for, but they're asking to buy property. So the agent who had the lead had been sitting on it for 3 weeks. Our sales manager, JT, at the time saw it and said, hey, what happened to this? Let's call him and see if we can get him in the office. Turned out that one client, that one relationship, it was probably the biggest relationship in our company's history, generated 10 million plus in revenue for us, all from a lost lead, right? So that's how we turn a negative into a positive.
All too often, because this is still a numbers game and a people business, whether it's on the retail side or the wholesale side or the property management side. The math is the math and the percentages are the percentages, but if you're not dotting your I's and crossing your T's, the percentages and the math will go against you pretty quick.
Yep.
So we're going to take a break. When we come back, it's going to be time for the Money Minute. Cool. All right? Stick around. We'll be right back.
REI Inc. is a monthly business publication for real estate investors, covering all types of real estate investments and strategies. It is the most comprehensive real estate investment publication on the market. All of the articles are written by the top leaders in the industry, so investors are assured of always getting the best information possible. Each month, REI Inc. also profiles the top companies in the industry and provides insights and data into key regional markets. Along with their sister platforms, the REI Referral Network and Highest Invest, real estate investors have exclusive access to off-market investment opportunities and national acquisition and disposition initiatives. To learn more, visit www.rei-inc.com, where you can also access the REI Referral Network. Also, be sure and visit www.highest-and-vest.com to view the latest exclusive off-market assets with near immediate acceptance decisions and closing strategies. You can also email marketing@rei-referralnetwork.com to request more information.
Welcome back to Uncontested Investing. I'm your host, Tim Herriage. I'm here with Josh DeShong. Josh, it's time for the Money Minute. So imagine there's an entrepreneur out there, an investor, someone listening to the podcast. They're only going to get 60 seconds of advice all month. Like, this is it. I mean, the volume is shut off after this. Pour into them and just I'm sure you already got something, right? So 60 seconds. Here's the Money Minute. Go.
60 seconds to tell you, build a freaking plan. All right. So often people say, I'm going to build a plan. I'm going to plan all this stuff out. But a plan is very simple. It has two things. Number one is, what is your objective? What objectives are you going to hit in 6 months? What objectives are you going to hit in 12 months? Just put the number up. You don't have to come up with a lot of thinking. Hey, I'm going to flip 5 houses in the next 6 months. I'm going to do 10 over the next 12. Just come up with a number. The second thing is come up with the criteria for which you're going to buy. So that is your buy box. I need to generate a 20% cash on cash return. I need to generate a 40% cash on cash return. Come up with your investment buy box, tie that in with your plan, and then start to execute, and you'll figure out the how over time. You don't need to figure out the how today.
Okay, you don't need to figure out the how today. The how confuses a lot of people. What's your why?
What's your why? Ooh,
Yours.
That's a totally loaded and different unscripted question. All
But
right.
it's not.
But I mean, it is.
Well, it is unscripted. This is rapid fire.
All right, yeah. So my why, my driver, what I learned a long time ago. When I started in real estate, I had nothing. I started with $500, and I was hustling things off Craigslist. I was going out and buying a PlayStation, marketing up $50 and selling it to somebody else, all the while making cold calls in a real estate office. So my why back in 2012, once I had started achieving some success, it changed. Originally, my why was all about money. I liked the game of making money. It wasn't that money made me happy. I just really liked the game. What I realized, though, in 2012, 2013 was my passion is actually for helping others, seeing others win. And what I realized is I will always win as long as I focus on making others successful. My wins come with that. And the more I've focused on other people, the more I've actually won. So that's been huge.
I mean, that's fire, that's money, because it's very common when you look around, successful people, by and large, are people that lift other people up.
Yeah. Well, and the game goes from okay, I need to make money, to how do I make money through people, and then how do I make them more money, and then how do I make my customers more money, and then it's just leveling up, right?
Are there any risks that are kind of like a red line for you, like you won't do it in your investing business?
Yeah, so every risk we have is combined with a return. So there is nothing I won't buy if the return is great enough. So what I mean by that is, if you called me and said, "Hey Josh, I have a hangar out in Tyler, Texas." Well, I'm going to be only offering pennies because I'm not going to be able to generate the same return that, maybe a pilot could. I don't know, right? So I will buy anything as long as the return is properly sized.
So there's always a mitigating factor.
Always.
Saturation in certain markets like Louisville, the example we used earlier, and then we were also talking about 50% of home sales in Tarrant County in a certain, we're institutional.
Institutionals, yeah.
Do you think that's a big problem nationwide? Is it localized? Is it not a problem at all?
So I think there's two things. One is, it's sad because the American dream is not quite what it was at one time. So that stinks. But aside from that, look, 10 to 20 years from now, there's going to be a subset of the single family inventory that's institutional or mom and pop investor owned. Majority of Americans will rent their house until they hit a certain age. And then maybe they decide to settle down and plant roots somewhere, but maybe they don't. Maybe Americans into the future are more transient.
When I look at the United Kingdom, and I've talked to some people, I feel like we're heading that way, where if you live in a major metro, you don't own, and if you live in the country, you own. And when I look at my nieces and nephews that are in their late 20s now, I can absolutely see most of them never owning a house.
Right.
Like, it's just,
right.
They have no desire. I mean, we're talking. One of my nieces makes like damn near $100,000 a year, and would rather rent.
Yeah.
Just not sure about things. So I think that that they also watch the foreclosure crisis. Wipe out their friends' families and houses, and so I think there's a little bit of maybe the next generation will really want to own a home. You used the word crashing earlier. I think we were talking about multifamily. You said something about will come crashing down. Do you feel like there's going to be a housing crash?
No, not even close.
Do you feel like there will be a further equities and bonds and stock market crash?
So I'm not a trader, but I would say that there should be in certain sectors. So if it was a SPAC deal, probably. If it made its way to the public markets via an acquisition, then I think that there's probably still more room to fall. But looking at other parts of the market, I think there's definitely sectors that are very healthy, right? Healthcare is not going to slow down in the next decade. So I think it depends, and that sucks to give you that answer.
No, it's fine because
I will say this. So I am in crypto. I'm invested in crypto. I believe in blockchain technology. I think there is a bigger crypto crash coming. I think it's going to get worse. And I would tell your listeners to think about back in 1903, there was 3,000 auto manufacturers. 3 of them made it out, Chrysler, GM, and Ford, right? Yeah. The odds that they're going to pick the right altcoin or the odds that Bitcoin is the one that makes it, they're slim. So just understand, you better be expecting a high return.
Well, never forget, the U.S. digital dollar comes out next year.
Yeah, there you go.
You talked about bond buyers, and I find that, as you know, we securitize and all that. Yeah. So it's all about the bond buyer. Now that the Fed isn't the largest AAA bond buyer, I think we could get to a point where we have a liquidity squeeze on the bond market, but then also it's the risk reward. The yield's got to go higher if you want them to take the risk with their capital. What do you think? You think we've topped out on interest? What do you think we top out at on single family FHA purchase 30-year mortgage interest rates?
7.5 to 8.5.
7.5 to 8.5.
You said FHA. So
Yeah.
I'd say 7.5 to 8.5. Now, I think there's 2 trains of thought here. One is we may be in a post-interest rate world. The Fed just hasn't realized it yet. Or 2, interest rates are going to rise, but housing values are going and incomes are going to rise, justifying that, right?
Personally, I feel like we had a hard reset. And we just haven't acknowledged it yet.
Yeah.
When I look at my hometown McDonald's, they're paying $15 an hour for people to show up. In what world do we get to where McDonald's can get that wage back to 10 or an 8 or 9? I mean, that's a 50% decrease. Yep. And when I look at it, Amazon, $18 an hour was their starting wage last year. Before that, it was $12. Everywhere I look, hourly wages of production employees, maybe not people that, sounds awful, work with their brains and work remote from home, right? They only got 5 or 10% increase. But the core of the products and services and delivery and fulfillment and creation people, I mean, they got significant raises.
Yeah.
And so I don't know. It's such a long conversation. I'm gonna stop saying it, but I do want to give you a chance to talk about with regards to your trapped equity. That'll be the nice bow we put on it.
Yeah. Okay.
Are you thinking you're going to go get more of that equity out? You thinking you leave it the way it is? Like in the next 12 months, how are you viewing that trapped equity in our inflation situation?
So I'm leaving. I'm holding. I'm being very cautious. When I start doing stuff, I will be a buyer. I will use my cash first. Then I will start tapping my equity.
Gotcha. All right. We're out of time. I want to give you a chance to parting shots, parting thoughts.
2 things. You only fail when you give up. And rich people buy time and poor people sell it. So think about that.
People buy time and poor people sell it. All right, if someone wants to get a hold of Josh, where do they go? Who do they call? What website?
So add me on LinkedIn, Josh DeShong. Feel free to shoot me an email, josh@Trelli. Or I tell you what, my cell phone number, text me, 214-679-4155.
And I'm betting that's not your cell phone.
No, that's my cell. That is my real cell.
Brave man, second person to give out their cell phone. Hopefully we do a good job and get you thousands and thousands of personal phone calls.
Yeah, I tell you what, just send me a text, just send me a text.
Well, Josh, it's been a pleasure sitting down with you. Thank you for coming in. Thanks for watching the Uncontested Investing Show. That's it for this week. We'll see you next week. And remember, your network is your net worth. And today you've been growing both. We'll see you around.
Thank you for listening to the Uncontested Investing Show. Questions about today's episode or the podcast? Email podcast@rcncapital.com and make sure to follow RCN Capital on Instagram, LinkedIn, and Facebook. See you all next time. The preceding program is furnished by RCN Capital LLC. The information provided is for general education purposes only and does not constitute any legal, financial, investment, or other professional advice. The views, thoughts, and opinions expressed of any speaker are the speaker's own opinion and do not represent the views, thoughts, and opinions of RCN Capital LLC. No information contained in this episode should be construed as financial, investment, or legal advice from RCN or any individual, author, host, or guest. You should always consult a financial advisor before investing.